The most pronounced market trend of the past 12 months has been the sharp rise in central bank policy rates. But how tight is monetary policy really? While most central banks outside of China and Japan have been raising rates, the extent to which they have increased rates varies a great deal from one country to another. In places like Canada and the United States, for example, central banks have taken rates up to roughly the level of core inflation. By contrast, in most other highly developed economies, central bank rates remain anywhere from 1.5% to 3% below the rate of core inflation. Some countries like Japan and Switzerland might like it this way, since inflation is finally, after many years of being too low, come up to their central bank's target levels. But central banks in places like the UK, Australia, and Sweden might be afraid of raising interest rates further because of the political and economic consequences of further policy tightening. All three of these countries have high real estate prices and a large portion of the population on variable rate mortgage loans. If these central banks keep raising rates, they could provoke a crash in real estate markets, which could in turn impair bank balance sheets, as happened in places like the US, Spain, Ireland, and Japan in past decades. As such, global economic trends towards higher interest rates mask strong divergences in how far central banks are willing or able to go in terms of tackling inflation.